Section 45 to 54 of the Income Tax Act of 1961. Introduction. Under Section 2, Subsection 14, capital gain means any profit or gain on transfer of sale of property of any kind like land, building, plant, machinery, furniture, goodwill, shares, bonds, etc. held by an assessee whether or not connected with his business or profession. The following assets does not include under capital assets. What are all they? First one, any stock in trade or consumables or raw materials held for the purpose of his business or profession. Personal effects including wearing apparels and household furniture, but excluding jewelry held for personal use by the assessee or any member of his family. Agricultural land in rural areas. Rural agricultural land means 2 kilometers away from the jurisdiction of a municipality which has population of more than 10,000 but not exceeding 1 lakh, or 6 kilometers away from the town which has population of more than 1 lakh but not exceeding 10 lakh, or 8 kilometers away from the town which has population of more than 10 lakhs. Next one, 6.5% gold bonds issued in the year 1977, 7% gold bonds issued in the year 1980, or national defense gold bonds issued in the year 1980 by the central government were all not treated as a capital asset. And special bearer bonds issued in the year 1991, gold deposit bonds issued in the year 1999, and deposit certificate issued under Gold Monetization Scheme 2015. These assets are excluded from the capital asset. Any profit or loss arising by sale of this asset was not taxable under capital gain. Basically, capital assets were classified into two categories, namely long-term and short-term. Long-term assets means assets which are held by an assessee for more than 36 months immediately preceding the date of transfer, which includes jewelry, ornaments, archaeological collections, drawings of any works of art, and other movable assets. And 24 months in case of land and building, and 12 months in case of listed equity shares and equity mutual funds, debentures, zero coupon bonds, and all listed securities, etc. Otherwise, it is called short-term capital asset. Tax rates for capital gain. Any long-term listed equity shares or units under Section 112A, only 10%. Under Section 111A, only 15%. All other long-term capital assets, tax rate is 20% each. The next term is a transfer or sale. Under Section 47 of the IT Act, transfer means exchange or conversion of ownership and possession of one asset into another form with equal consideration. The following transactions which do not constitute transfer, what are all they? Any distribution of asset on the total or partial partition of HUF, any transfer of capital asset under gift or will or irrevocable trust, any transfer of a capital asset by holding company to its subsidiary company or vice versa, any transfer in a scheme of amalgamation or merger of a capital asset by the amalgamating company to the amalgamated company, any transfer of a capital asset of such foreign currency bonds or global depository receipts by non-residents to another non-resident made outside India under Section 115 AC, any transfer by way of conversion of bonds or debenture stock or deposit certificate into shares or debentures of that company, transfer of asset of historical importance to the museum or National Gallery of Art, any transfer of asset by a proprietorship consent to OPC or partnership firm, any transfer of shares or assets in the event of absorption or amalgamation or external reconstruction of an organization. And the next term is a self-generated asset. Reputation of the business like goodwill, tenancy right, patent right, copyright, or the process of any article or thing are called self-generated assets. The actual cost of these assets would be treated as zero while computing taxable capital gain. The next term is cost inflation index. What is cost inflation index? It is the index used to calculate or determine the inflation adjusted rise in the value of an asset. The assessee can utilize the indexation benefit. The cost of the asset would be more and the tax liability would be less under capital gain when we are applying indexation. So cost inflation index is used only for long-term capital asset but not for business hold and short-term capital assets. Let me start how to compute taxable long-term capital gain. Shall we go for the format? Right. First we have to consider sale proceeds or stamp duty value. For the stamp duty value, up to 1% of the stamp duty value was allowed. So up to 110% of the stamp duty value or sale proceeds value. Out of these two, whichever is higher, first we have to consider that one. Less any expenses on sales or transfer. So balance value is called net consideration. Net consideration. Here we can apply less indexed cost of acquisition for long-term capital assets only. First, cost of purchase. Actually, this cost inflation index was introduced in the year 2001 to 2. So the base index is 100. Our accounting financial year is 2021-22. The current index is 317. So we have to convert the cost based on the year of purchase with the help of that index, that is called indexed cost of acquisition. If any cost of improvement made in another year or in any of the year, we have to apply the same cost of improvement or cost of additions, indexed cost of improvement or indexed cost of additions. We have to calculate the same pattern. Here we have to consider the important note. Cost of acquisition. If any asset acquired before 1/4/2001, the cost of the asset shall be actual cost of the asset or fair market value as on 1/4/2001, whichever is higher be considered. For land and buildings, stamp duty value as on 1/4/2001 be considered. Second note, if asset is acquired by gift or will, cost of the previous owner shall be the cost of the present owner also. Note 3, cost of improvement, any expenditure incurred to make additions to the capital asset. If any cost of improvement made before 1/4/2001 shall be ignored. So, if any asset sold based on, with help, if that sale proceeds invested in any of the asset, so based on the investment out of long-term capital gain, we can claim some exemptions. Various exemptions are allowed under capital gain. One by one, let me see. First, let's exemption under section 54, that stands for transfer of residential house property. The amount of exemption will be long-term capital gain or actual investment in the new property, whichever is leased. Here we have to check one condition. Investment should be made 12 months prior or 24 months in case of purchase, or 36 months in case of construction after the date of transfer. Then only we can claim exemption. So transfer of residential property. If one residential property is sold, with that sale proceeds, if we purchase another house property, we can claim exemption under section 54. In the same pattern, we can claim exemption under section 54, that stands for transfer of land. Here condition is investment should be made within 6 months after the date of transfer. The amount of exemption will be long-term capital gain or actual investment in the new land, whichever is leased. Next is exemption under section 54D. Here it is compulsory acquisition of land and building by government for infrastructure activity. Here the actual compensation granted by the government or long-term capital gain, whichever is least, was exempted. Next, exemption under section 54EC. If any amount invested in the bonds of REC, Rural Electrification Corporation, or NHA, National Highway Authority, or IRFC, Indian Railway Finance Corporations. If we made any investment in the bonds of these institutions, we can claim exemption under section 54EC. The amount of exemption is long-term capital gain or actual investment in the bonds. Up to 50 lakhs allowed. Investments should made within 6 months after the date of transfer. It's a condition. Okay. Next, Exemption under section 54 double E. If any investment in new starts up or stand-ups in India, amount of exemption up to 50 lakh or actual investment in the startup, whichever is least, is allowed as exemption. Next, exemption under section 54F, here, any investment in the residential house property. The first is exemption under section 54. 54 stands for transfer of residential house property. But 54F stands for investment in residential house property. If any asset other than residential property, in case of shares or jewelry or gold sold, that sale proceeds was invested in the residential house property, means in such a cases we can avail exemption under section 54F. The amount of exemption equal to long-term capital gain into actual investment by net consideration. You have to apply this formula. Next, exemption under section 54G. It stands for any transfer of industrial undertakings from urban area to rural area. The amount of exemption is long-term capital gain or actual investment in rural industry, whichever is least. The next is exemption under section 54GA. Transfer of industrial undertaking from urban area to special economic zones. Next, exemption under section 54GB. Investment in certain equity shares by sale of residential house property. The amount of exemption is long-term capital gain and actual investment in equity shares by net consideration. So the balance value is called taxable long-term capital gain. Actually, the cost inflation index given in the problem itself, so students do not get worried. Based on that cost inflation index only, we have to compute the indexed cost of acquisition and the indexed cost of improvement. A simple problems. Let me start. Practice 1. Sale value of building as on 15th September 2021, 50 lakh. Stamp duty value on 1/4/2021 was 54 lakh. Here the actual sales value 50 lakh, but the stamp duty value 54 lakh. So the differences between the sales value and the stamp duty value is within 110%. The stamp duty value is less than 110% of the sales value. So here we can select both these, either 50 lakhs or 54 lakhs, whichever is higher. So 54 lakhs will be treated as a net consideration. The second, practice 1A. Sales value of building is 50 lakh, but the stamp duty value is 56 lakh. So the sale value 50 lakh into 110%. So if the stamp duty value 55 lakhs, we can compare the sales value and the stamp duty value. But here the stamp duty value is more than 55 lakhs. That means more than 110% of the sales value. So the difference between these two will be taxable under income from other sources. That will not be considered under capital gain. Here the net concession will be only 50 lakhs. Okay. Next, practice 1B. Calculate the indexed cost of house for the assessment year 22-23. Cost of house purchased in December 98 for rupees 1,25,000. December 98 before 1/4/2001. So in this situation, the fair market value as on 1/4/2001 will be given for such property. So we have to consider only the fair market value and the cost price before 1/4/2001, whichever is higher. We have to consider the cost price, whichever is higher, that one. Yes, see this example. The fair market value as on 1/4/2001 is 2,20,000. The actual cost before 1/4/2001 is 125, but the fair market value is 2,20,000. Whichever is a greater value, so 2,20,000. So we have to consider this 2,20,000 only when computing indexed cost of acquisition. Let's see cost inflation index calculation. Year 2001 to 2. Index 100, but our accounting year 2021-22, the index will be 317. The cost or fair market value, whichever is higher, 2,20,000. So for 100, 2,20,000 means what for 317? That is called, in such a calculation is called indexed cost of acquisition. So the indexed cost will be 6,97,400 for the year 21-22. Actual cost is only 125, but the fair market value is 2,20,000, but the indexed cost is 6,97,000. Only for the benefit of the assessee, indexed cost was introduced under capital gain. Let me see practice 2. Compute taxable capital gain. House property purchased in the year 2006 to 7 for rupees 4 lakh. Cost inflation index for that year is 122. Sold in December 2021 for rupees 28 lakh. Cost inflation index for this year is 317. Purchased another property in January 2022. So the old property sold and he purchased a new property, that is called transfer of residential property. In the cases we can avail exemption under section 54. And deposited in capital gain account scheme in January 2022 rupees 2,50,000. So capital gain deposit scheme is permitted to claim the exemption under section 54. So the total amount of investment in the new property is 10 lakh. Please understand the problem. Computation of taxable capital gain. The property, the asset sold is house property. Sale precedes a stamp duty value, whichever is higher, 28 lakhs. Okay. Less expenses on sales, nothing is there. So the net concession is 28 lakhs. Less indexed cost of acquisition. Yeah, this property is purchased in 2006 to 7. In that year, the cost inflation index is 122. The actual cost was 4 lakh. So for 2006 to 7 index 122, cost is 4 lakh. What will be the indexed cost for the year 2021-22? The index is 317. Just we have to do the cross multiplication. So the amount will be get rounded off to nearest rupees 10 for our simple calculation purposes. So the index cost will be 10,39,340. So balance amount is long-term capital gain. Here we can claim exemption under section 54, transfer of residential house property actual. Purchased property 54(1), 7,50,000 and deposited in capital gain scheme 54 subsection 2, 2,50,000, totally 10 lakh. Or actual 17,60,660, whichever is the least. 10 lakh is exempted, so balance 7,60,660 is taxable long-term capital gain. In the same pattern, the students can do the exercise 1 and 2 and check up the answer. Now let me go for the practice 3. From the following information, compute taxable capital gain. Land acquired on September 98. Land, September 90, before 1/4/2001. So for such a property, there will be definitely fair market value as on 1/4/2001 will be there. So we have to check it up. Actual cost before 1/4/2001 or fair market value as on 1/4/2000, whichever is higher will be treated as a cost. While computing indexed cost, such a cost only will be considered. Stamp duty value 8 lakh. Sold in December 21 for rupees 42,80,000. Commission paid on sales 80,000. Amount invested in another piece of land 15 lakh. Cost inflation index for the year 2001 to 2 is 100 and 2021 to 2 is 317. Let me see how to compute. The property sold is land. Sale proceeds 42 lakh and 80,000. Less expense on sales 80. So balance 42 lakh is net consideration. Here we have to apply the indexed cost. Here 2001 to 2 because actual purchases in September 98. But the stamp duty value on 1/4/2001 is 8 lakh. Whichever is higher, 8 lakh. So for the year 1 to 2, index 100, cost is 8 lakh. What will the indexed cost for the year 2021-22 for the index of 317? It will be 25 lakh and 36,000 is the indexed cost. So balance will be long-term capital gain. Less exemption under section 54B. In the first sum, we availed exemption under section 54 because of transfer of residential property. But in this problem, we availed exemption under section 54B because it is transfer of land. Actual cost of the new land is 15 lakh, but the actual capital gain is 17,44,000. Whichever is the least, 15 is exempted. So balance 2,44,000 was taxable long-term capital gain. So in this video, actually, I stated only the format, how to compute the long-term capital gain, entire format, and just an introductory problem of how to claim exemption under section 54 and 54B only. Let me see in the next video the comprehensive problems on the capital gain. Okay, bye.